Hello bro, and welcome back to the new stock market video. Today we are going to analyze AGNC Investment Corporation with the stock ticker AGNC. And there are going to be two reasons why we are going to analyze it. Okay, first of all, this company is paying monthly dividends, which is absolutely perfect for us if we are dividend investors, And the second reason is they have an extremely high dividend yield. Take a look, bro. 15%, okay, which is the highest that I have seen so far, bro. So I was thinking, okay, let's make a video because I want to prove you that dividend yield, the highest one, like high dividend yield, does not mean that the stock is good. Okay, now let's take a look at the example if this is true in this company as well. Okay, as always, we are going to analyze this company using little Canva presentation that I prepared right now here. So let's begin. First of all, why should you even listen to me? Because I'm some random guy from the internet, right? My name is Yasha and I help young men from middle class invest in the stock market and actually help them make money with it, okay? Now this is me right now here. And if you are interested in that, bro, click the first link in the description. Now let's begin with the actual analysis. So this is going to be very beginner, simple, straightforward analysis. I don't want to waste any more time from you. So let's begin, okay? First of all, as a complete beginner, bro, you should care about the following 6 things. You should care about chart, profit, debt, money, value, and price. Now, first of all, AGNC is one real estate investment trust, which basically reinvests money in the real estate and then resells it further or rents it out. Okay, it was founded in 2008, which is a relatively new company, and they are investing in mortgages. Okay. Now let's begin with the first thing that we are going to analyze, which is the chart right now here, okay? Now here we have a little instruction that tells us chart has to grow for all 10 years. Now what exactly does that mean? That means that I will first of all draw a little exponential growth line, kind of like this. And then we are going to compare the actual stock price chart with this black line, because preferably we want to invest in stocks that grow exponentially, okay? And what is the reason here, or what is the case here? The chart is going downwards, it's falling, and we don't want to see that at all, okay? Because preferably the chart would be kinda like this. Of course, up and down, but following that trend upwards, okay? And now we come to the profit, and for profit we have an instruction. Profit has to be in plus and it has to grow. Now, what do you see here, bro? I can immediately see 1 red flag, 2 red flag, and 3rd red flag. An additional red flag, the profit doesn't grow fucking exponentially, it grows up and down, and it goes to the minuses right now here, bro. So this is, you know what this is? SHIT. This is fucking shit, okay? We don't want to invest in companies that have minus. That's a fact, bro. Whenever you see net income, which is the same as profit, whenever you see that in minus for the last 10 years, just say fucking goodbye. Dump that bitch, okay? So here, profit also no go. We come to debt, and instruction tells us that debt has to be low. Now, this is one of the very few companies where the debt is actually low, even though this is a bit concerning for me. Why? Generally, we want to be debt as low as possible, plus decreasing through the years, okay? We want to see that. But the problem is with this business model from this company, okay? Listen, this company invests in real estate. You can buy real estate with debt, okay? Because the best strategy to buy real estate is to get to a bank and get a debt, okay? Go to bank, get debt. It's that simple. So if they want to grow, their debt should actually be growing. It has to be increasing through the years. But here we have exactly the opposite. Debt is fucking decreasing. Now what does that mean? They are buying less properties, which means less rent money, which means less fucking profit. Less fucking profit. You understand, man? And that means stock price goes down. It's that fucking simple, okay? So I know generally we should want to see low debt, but here it has to be the opposite. Whenever you have real estate fucking company, which is REIT, okay? RIET, whatever is that pronounced, bro, I don't know. Whenever you have real estate company, debt has to be high, okay? Now here it's exactly the opposite. Fuck this. And now we come to the money, and with the money, we want to see how much money do they have on their bank account. That literally means how much money do they have on bank account, and then so that they can go to one local bank, I don't know, to Wells Fargo or Bank of America or Chase, and withdraw that money. Just like you, when you go to ATM machine and you withdraw the money, here we are measuring the money that they can withdraw at this exact moment, okay? Now look at here, they want to have more money than costs on their bank account, because obviously you want to have money on your bank account, right? If you have zero money, if you are a fucking broke person, then no woman will fuck with you, okay? No woman will give you pussy, okay? And here it's exactly the same. We are buying companies that are fucking rich, okay? And now what do we have here, bro? Take a look. Minus $120 million, so to say, okay? So they have less money than the costs, which means they are in minus, which means they are broke in terms of the money on the bank account. We don't want to see that again, okay? That's a no-go. Now we come to the value, and preferably we want to invest in stocks that are undervalued, okay? Now, how do we measure the valuation? We measure it by two little concepts. First of all is P/E ratio, and the second of all is intrinsic value, okay? Now, I know that this might sound a bit confusing as a beginner, but stick with me right now here, okay? Look, P/E ratio is some calculation that we calculate to see if the stock is undervalued in comparison to the competition, okay? And preferably, you want to have P/E ratio lower than 15. And intrinsic value tells us what price should the stock have at this exact moment, and it should be higher than the current price, okay? Now, what do we have here? P/E ratio is 10, and this is actually lower than 15, so in terms of the P/E ratio, AGNC is undervalued. This is what we want to see, okay? Now, let's take a look at the intrinsic value now. So, as I told you, bro, intrinsic value is the price that the company should have at this exact moment, okay? So this would be the fair price of the stock, okay? It should be priced at $32, but the current price of AGNC is actually $9, which means that the current price is actually $20 lower than it should have been. Do you know what I mean? I know that I'm repeating myself constantly, but this is very important concept. Now, intrinsic value is higher than the current price, which means that the stock is actually undervalued in terms of that price as well, okay? So stock is undervalued. This is finally one first good news about this company, bro. You know what I mean? So you can find P/E ratio and intrinsic value on the internet. Just go to Google and write AGNC P/E ratio, AGNC intrinsic value. It's that simple, okay? And now we come to the price, and for the price we want to invest in stocks that are lower than 150 euros, because obviously we want to invest in stocks that are not expensive. And that border 150 euros or dollars if you are from America is that border where I decided that this is actually the top limit so that we can buy the stock and it's still not expensive, okay? I don't want to spend more than 150 euros on a stock, because if I buy some fucking Nvidia that cost a few months ago like 1,000 euros, and if it goes up for 40 euros, you get maybe fucking 4 cents out of it, you know? So it doesn't make sense if you buy expensive stocks. It's that simple, okay? Below 150 euros, always aim for that, or dollars because you are from America, okay? Now the current price is around $10, which is lower than $150, which is fine, okay? Two good news so far. Now we come to the final evaluation, bro, where we are just going to summarize everything that we found out about this company so far. So let's begin, okay? Is chart growing exponentially? No, it's not. It's growing downwards exponentially. It's decreasing exponentially, okay? Is profit good and it's growing exponentially? Not. Again, it's not growing because it has 3 minuses. If you don't believe me, go a few minutes back and watch the whole video again, okay? Do they have decreasing debt? Yes, they do have. But in this case, we want to have increasing debt because you buy real estate with the debt. Everyone does that, okay? So in that case, if they want to grow the business, they need to have higher debt. So here I will mark no as well, okay? Do they have money on the bank account? No, they don't, because they have minus $120 million. Is the stock undervalued? Yes, it is. And is the price below $150? What the fuck? Yes, it is, okay? Now, what is the conclusion, bro? I think that we should fucking sell this stock. I think that you should not touch it because of the following. I told you before, bro, at the beginning. Higher dividend yield does not mean that the stock is good, okay? And this is exactly the same reason. Look, the stock price is falling. Look at that here. Look, it's falling down. They have 3 minuses within 10 years, which is what we don't want to see. They have decreasing debt, which means that they are not growing. They don't buy new real estate. They have minus on the bank account. They are undervalued, which is a good thing. But generally, bro, they are fucking shit. Like literally, this company is one of the worst that I have seen. Look, here I did a more detailed evaluation of the company, and take a look at here. These retained earnings, they tell you how much money does the company reinvest back into itself, okay? And if you want to have a growing company, obviously you need to reinvest more money into the company, okay? But here it's the opposite, which means that they are paying money for the dividends that they should have reinvested. They are fucking paying more money to the dividends instead of growing the business. But that's one little thing, bro. Look at here. Wait. Look at here. If they want to be untaxed, they should reinvest more than 90% of taxable income to the shareholders. That's why they are fucking shit, bro. They only care about the dividends and not the business. So in my personal opinion, bro, even though the dividend yield is high, you should not buy this company, in my opinion, bro. After all, you do your own decisions, but I wouldn't even touch this company, okay? Now, if you want to know more about stock market evaluation, how to actually make money, bro, click the first link in the description, subscribe, and do the hard work, bro, and see you on top of the world.